welcome to this edition of Conversations with Claris. Today we have Chris Bettonville here with us from Claris. And Chris, we're going to talk today about, or at least a question I'm going to ask is, we see and we hear a lot about fees of mutual fund companies, and we'll get questions from clients trying to explain what those are. And I don't think people realize how important costs are when it comes to investing. And not too long ago, we just got some news that one of the fund companies we use has reduced their fees, which is important and good. But that's been going on by them for probably the last 10 years. So with that being said, can you just elaborate a little bit on fees, why they're important?
Yes, Dan. To your point, I think there's been a very positive trend in our industry surrounding fee reductions at fund companies. And specifically within our portfolios, Dimensional Fund Advisors has been aggressive, especially within the past year, of reducing those fees. And they've also introduced low fee ETFs as well to compete with some of those mutual funds. And we are seeing further fee reductions this year going into 2022 with Dimensional surrounding their small and small value funds, both domestic and internationally, which is great news given that those tend to be higher expense funds to begin with. And for us, that's great news for us. That's great news for our clients because, as you mentioned, fees do matter. And I think it really comes down to controlling what we can control. We can't necessarily control what the markets are going to do. We can't control how those funds are going to perform within any given market necessarily, but we can control the expense of the investments we put in a portfolio. And at the end of the day, that's important because those fees and those expenses really operate as hurdles to profits and returns for investors. And the greater that fee or expense, the greater the bar that a fund company has to clear before they may even generate a return. For example, if a fund company has a 1.5% expense ratio before an investor even sees a penny on their investment, that fund company has to have a positive return in any given year of 1.5%.
Right.
And to take that further, it becomes kind of exacerbated, especially as they compete with lower cost peers and lower cost funds. So I think everyone might think they're okay with paying a little more fees or expenses if they're going to get a greater return. But when you put that in perspective, that company that you're paying those greater expenses to has a wider margin that they need to consistently every year outperform their peers by just to either break even or then outperform like they'd hope them to. The evidence has shown that that's just not really realistic or doesn't hold up over the long term. And then even to flip that on its side, with the expectation that there will be down markets and down periods, that every fund will go through. Those excess fees or those larger fees are going to act as an anchor on those funds as well, just exacerbating those negative situations and further reducing the return of those expense fund companies.
Right.
So,
I think that a couple things. I think that good news, obviously, that anytime we see fund companies that are lowering expenses, that's great. Second of all, I think the other thing that you mentioned was, again, going back to controlling the things that we can control. We can't control what they charge in expense, but we sure can't control whether we use that fund or that investment. So that is in our control. So I think a couple key points there, Chris. I appreciate the insight. Thanks for joining us. Join us again for our next monthly conversation with Claris. We'll see you.